Batra, and it is turning out to be a session where we are seeing some amount of semblance of sanity, at least for the markets at this point in time. So we have the Bank Nifty, which is up around 0.6%. Remember that the Bank Nifty has corrected quite significantly on a month-to-date basis. And we have the mid-caps, which are crawling back as well. So we have the mid-cap index, which is up around 1.3% at this point in time. Lot of result reactions to talk about. Case in point would be TechM, which is in fact the top loser on the Nifty at this point in time. And a lot of numbers to look for as well. So for example, we have Sun Pharma, which is lower ahead of its numbers. So it's one of the Nifty numbers which will be coming out today. So down around 1.2% ahead of that. Turning out to be a session which is going to be quite cautious and quiet ahead of the budget, not to mention that we have the Fed policy to reckon with as well, along with expiry. So a lot of cues to watch out for this week. For today, it is the economic survey, which we will be shifting focus to in just a couple of minutes. Hi, Sonia.
Hi, Ekta. Afternoon. Absolutely. There's so much to reckon with. So let's get straight to individual stocks then. And of course, as and when the economic survey is tabled, we will talk about that in greater detail. First up, Sonal, my colleague, is joining in. BPCL is the stock that's buzzing in trade this afternoon. Sonal, over to you.
Thanks a lot for that. Yes, a good set of numbers coming in from BPCL. It was a top-down beat. Revenues were up 4%, EBITDA higher than the poll at 4,200 crore rupees, and margins at 3.6% versus an estimate of 3%. Net profit also at almost 2,000 crore rupees. It is versus an estimate of around 1,400 crore rupees. It was led by the refining segment, where the reported GRMs came in at $15.50 per barrel versus an estimate of $15 per barrel. Even the marketing volumes were up 12% on a sequential basis versus an estimate of an 8% growth there. Margins now in petrol are at 10 rupees per litre, but diesel continues to see losses of around 6 rupees per litre. So the next big thing to watch out for this stock is the upcoming budget, because Jeffrey says we'll get more clarity on government policy for providing any subsidy or any compensation, because these companies could not go ahead and pass on hike in crude prices to the customers. They have a target price of 445 versus 410 rupees per share earlier because of this big beat that we saw in Q3. ICICI Securities says that they believe FY24 will be fairly normalized now. The earning trends, at least in the refining segment, are looking stable, and sharply higher marketing margin scenario is something that they are looking at as well. Motilal Oswal says crude prices have remained strong even as GRMs have fared better in the last 2 quarters, and which may bode well for the stock. So they are also positive on BPCL. On the back of strong set of numbers, the stock is higher in trade.
Okay, all right, Sonal, thanks very much for that. That's on BPCL. But let's shift back to the big story of the day, which is the economic survey. The finance minister will be tabling the economic survey shortly, in just a short while from now. But before that, we do have Shireen joining us. She has sources telling us what we can expect from the economic survey. Shireen, over to you.
Well, thanks very much, guys. Yes, as we've been reporting through the course of the morning, the economic survey will be tabled shortly. But of course, our team, Sapna Das, Timsy Jaipuria, Parikshit Luthra, have been working the phones to try and get us an insight on what the survey is likely to say. In terms of growth, the growth numbers, the baseline scenario, 6.5% for FY24 is what the estimate is likely to be in the economic survey. Nominal growth at 11%, that is the estimate as well. But in terms of caution, the survey is going to address the issues of the current account deficit as well as inflation and the global macroeconomic volatility. In fact, the survey will talk about the fact that export growth may have plateaued on account of the current global economic uncertainty that we are seeing, and that could be a cause for concern. Even as far as the current account deficit is concerned, we are given to understand that the survey is likely to say that while for now, if the macros, global macros remain stable, we should be okay. But this is something that requires monitoring. And of course, as we're pointing out there, at this point in time, the survey also suggesting that there are incipient signs of a new private capital formation cycle being visible. So that's the good news there. And again, pointing on the fact that domestic demand will be the big growth driver for India. And of course, highlighting and articulating that it has been, the last year has been a year of resilience as far as India is concerned, and that, of course, has been corroborated by numbers in relative performance to what we have seen globally. So that's really as far as the highlights of the survey is concerned. Focus on domestic manufacturing, the focus on domestic demand driving growth, and of course highlighting also the reasons why India has been relatively better. But of course, as I pointed out, the concerns will be on the current account deficit, on the export growth slowing down. In fact, the survey, as I pointed out, seems to suggest that that will be a challenge considering that export growth may have plateaued. The rise in import costs on account of inflation, that of course is also going to be flagged as an area of concern that requires monitoring and for the government to be mindful of. So those are just going to be some of the highlights of the survey. But remember, this is all source-based information at this point in time. The survey yet to be tabled. Our team is, of course, working the phones, bringing you insights on the economic survey. I will hand it back to you for more on the markets and keep coming back as we get more.
Oh, absolutely, Shireen. Thanks a lot for that. Can't wait to hear what the economic survey has in store. Of course, as we head into the budget, there are a couple of pockets that are doing really well this afternoon. Have to point them out. The entire defense space is on fire as we speak. BEL is up almost 7%. Remember, defense is a big thrust area for the government, and the expectation is that there could be a 10 to 15% rise overall in capex spending across many verticals, whether it's manufacturing, defense, infrastructure. BEL is up almost 7%. BHEL is up almost about 6% L&T, of course, has that bit of an overhang because of its earnings, but this entire pocket, infrastructure, defense, we were speaking to CG Power a while back, and they mentioned that there is a large order wins slated in the railway space, and the government has its huge focus on that as well. CG Power also trending in the green right now. So plenty of stocks to talk about. The mid-cap end of trade is up about 400 points, although the sensex and the nifty are a bit cautious as we head into the economic survey. But as we take a short break, here's some exciting news for you. The most coveted leadership awards are back. CNBC-TV18 honors the visionaries behind outstanding businesses. Catch the most influential, credible, powerful IBLA jury on the 8th of February right here on CNBC-TV18. Welcome back. As I was telling you, the space to be in really is defense this afternoon. So not just BEL, but a whole host of other stocks. Keep them on your radar. HAL, there's BHEL from the capital goods space, of course, Bharat Forge, all of these stocks. BEL is the one that's charging away right now. Now, the capital outlay in defense services was around 1.5 lakh crores in FY23. It's expected to rise to about 1.8 lakh crores in FY24. So ahead of that, the stocks in the defense space are looking good. But L&T, can't say the same about that because of the numbers. It's a bit subdued. It's flat actually, but not reacting as well as the other capital goods makers. Vivek is joining in. Vivek, what has disappointed the street? Some caution on the EPC margins, as you were telling us earlier. But what else?
Well, absolutely right. If you're actually looking at L&T numbers, quite a mixed quarter. So talking about the order inflow and the order inflow guidance, very strong. In fact, management has mentioned quite clearly that despite recessionary headwinds that the rest of the globe are facing, GCC as well as India will continue to outperform. And they said that in the 9 months of FY23 so far, actually the order inflow was a lot better than what it was in the preceding years. And they believe that Q4 also, the order inflow is quite strong, and the guidance too that they gave is they're targeting to achieve the upper end of the guided range as far as the order inflow is concerned. However, the core EPC margins, that is the one that we track as far as L&T is concerned, that has been revised downwards. What they are now expecting is that 8.9% is what they are expecting to end the year at. Earlier, they had guided for 9.5%. Core numbers, slight miss as far as the core EBITDA was concerned on the back of higher raw material prices, especially steel, and some of the projects that the company executed in the quarter gone by were projects that the company had signed on earlier when steel prices were a lot longer. Two-thirds of the company's projects actually have price escalation clauses with the customers. However, these happen with a lag, which is what the management tried to indicate even in the call. So overall, most of the brokerages are quite upbeat, especially in terms of the order inflow. But the caution is, as far as margin guidance is concerned, is what is dragging the stock slightly lower in today's trading session.
Okay, all right, Vivek. Thanks very much for that. That's on Larsen and Trubro. But I am following one particular stock today, which is basically Loris Labs. Remember that particular company came out with numbers during market hours yesterday. It did come off the day's high in yesterday's trading session and completely flattened out. That was possibly because of that operational miss. Now it is seeing further pressure today. It's down around 3% They did hold their conference call post markets yesterday. So they have said, for example, the margins for FY23 are expected to be closer to 28%. Why is that a disappointment? Because the street was anticipating around 30%, which is what they had indicated earlier. The company is actively working towards achieving its revenue guidance of around 6,500 crores for FY23. The management believes that the pricing in the ARV, which is the anti-retroviral market, which is the anti-AIDS drugs, has bottomed out. Loris, in fact, was selected as a panel supplier by the Global Fund for ARV Drugs Procurement for a tender between 2023 to 2025. The CDMO segment, which is basically their synthesis segment, has around 60 active projects at this point at different stages. One animal health product, which is validated or expected to be validated in FY24. So that should be a new source of revenue for them as well. But the brokerages are not enthused. Jefferies, they've cut their target price to 325. They believe that the outlook remains uncertain due to Paxlovid, which is basically Pfizer's drug for COVID-19, the contract nearing expiry. Citi has a sell. Antique has maintained their hold, but they've cut the target price to 304. Kotak has upgraded the stock to reduce, and they have an unchanged target price of around 350. They believe they've reiterated the trouble on the following, which is on a following couple of points for the company, such as ARV pricing as well as Paxlovid sales, which continue to be a concern. Motilal has a buy with the target price of 440. So really divided, but largely concern and caution as of now for Loris.
Okay, very quickly on to some more stocks then before we get more details on the economic survey that's coming in right now. Aztec Life Sciences has slipped in trade after reporting a weak set of numbers. Ekta, quickly tell us, what did they look like?
Well, yes, it's recovered from the day's low. So the revenue is at around 117 odd crores versus 173 crores year on year. Margins have come down all the way to 10.3% versus 24.7% year on year, and a profit of around 83.9 lakh this quarter as compared to 24.7 crores. Even on a Q-on-Q basis, 117 crores in terms of revenue, close to around 200 crores last quarter. Margins 10.3 versus 17% last quarter. 84 lakhs in terms of profit as compared to around 18 crores in the previous quarter. So it is a dismal set of numbers. Cut it any which way you want for Aztec Life, both Q-on-Q as well as year on year.
Okay, well, for now, we are waiting for more details on the economic survey. It'll keep popping up for you on the screen. The market is going in slightly subdued, down about 0.2% for the Nifty. The sensex is down 150 points. In case you missed out on the budget quiz that CNBC-TV18 is having, remember there are prizes to be won every day. All right, before that, I think we're getting some first headlines on the economic survey. So let's go straight across to Shireen on that. Shireen, what are you picking up?
Well, not the first headlines. It's really a summation of the information that we've already put out. And as I said, our colleagues Timsy, Sapna and Parikshit have been breaking these stories for us. Some in substance, if I could just recap for our viewers what we do know so far. And this, of course, with the caveat, is source-based information still. FY24 real growth projected at 6.5%. Nominal GDP to expand by 11%. But borrowing costs may stay higher for longer, and that is what the survey is expected to say, as entrenched inflation could prolong the interest rate tightening. And that really sums up what the survey is likely to say as far as the macros are concerned. Once again, FY24 real growth projected at 6.5%, nominal GDP to expand by 11%. Borrowing costs may stay higher for longer, as entrenched inflation could prolong interest rate tightening. Of course, as we pointed out, we are waiting for the survey to be tabled. This is information that our colleagues have accessed so far on what the survey is likely to highlight.
Okay, all right, Shireen, thanks very much for that. So we'll keep getting you more details with regards to the economic survey. We should probably hear more on it in just a couple of minutes. But as of now, let's stay with the budget, and it's time for the CNBC-TV18 budget quiz. Remember, there are prizes to be won every day. We gave you the question at 9:14 today, but in case you missed it, here is today's question. What was the fiscal deficit to GDP for FY22? revised to in the last budget? And your answer options are A, 6.6, B, 6.7, C, 6.8, and D, 6.9%. Send us your answers on Twitter. Post your answer as a comment on the question tweet on @CNBC-TV18 News. Use the hashtag budget with CNBC-TV18. Now hurry and send us your answers. Remember, we will be announcing the winner at 3 p.m. Welcome back. Well, for the mid-cap index, it's up around 1.3%. Sonia was mentioning a lot of the defense stocks which are buzzing ahead of the budget on the possibility of a higher allocation towards that space. But do watch out for two other pockets which always seem to be buzzing ahead of the budget, which is basically the entire railway space. So the likes of Titagar Wagons, RVNL, all of these stocks are higher in today's trading session by anywhere between 2 to 3 odd %. Remember, a lot has already been announced for the railways in the past, so incremental announcements might not be as much. Separately, watch out for the entire fertilizer space because the subsidy figure always becomes important in terms of what is announced in the budget. A couple of the mixed fertilizer space, such as the urea as well as the complex fertilizer manufacturers, all of them are buzzing today. Deepak Fertilizer up around 3.6%. RCF, NFL, those are the PSU lot. They also buzzing around higher anywhere between 4 to 7 odd % for the entire fertilizer space. But let's get back to the frontline stocks. TechM is in focus. In fact, it's the top loser on the Nifty this afternoon, reacting to its Q3 numbers. Rima's here with more. Rima.
Thanks so much for that. So the top line for Tech Mahindra missed street expectations. Constant currency revenue growth at just 0.2% on a quarter-on-quarter basis, lower than estimates of 0.5% and lower than what peers have reported. Remember, companies like Infosys, TCS had more than a 2% growth. HCL Tech had clocked in a near 5% revenue growth. So in comparison, Tech Mahindra's top line growth of 0.2% is fairly muted. There was a furlough impact of 100 basis points in Q3, and there is some pressure in their top clients. So the top line revenues declined by 15% on a year-on-year basis and down 5% on a quarter-on-quarter basis. This is due to headwinds in a couple of clients related to an impact of internal restructuring, and the management expects this impact, the top clients restructuring, to bottom out in Q4. The other problem is even the outlook in the conference call was fairly challenging. The company indicated that some clients have pulled back on discretionary spending. There is delay in decision making. Smaller programs are getting squeezed. Some of the furlough impact will get spilled over into Q4 as well. And now the company is saying that it is time for them to be agile, to be very close to the client. So earlier, if they would do meetings with the clients on a quarterly basis, now they're going to be doing it on a monthly basis to understand how the tech requirements are changing. And the situation is so dynamic and uncertain that it requires them to do perhaps monthly meetings with their clients to understand the tech requirements. So the outlook also is a bit uncertain, and that's what's disappointed the street. Back to you.
Okay, thanks a lot for that. Well, the other stock that we're looking at this afternoon is SRF. It was a good set of numbers coming through from SRF, and the stock has also been quite buoyant actually through the course of the morning. Sonal is here with more details on that. Sonal, over to you.
Thanks a lot for that. Well, yes, good set of numbers. SRF reported numbers just towards the closing hour of trade. And as I said, it was a good set. Revenue of 4%, EBITDA down 5.5%, but margins at 24% was much better than what the street was working with. Profits were also up 1.2%. They announced capex plans yet again. They have a project to set up a dedicated facility to produce 300 million metric tons of SS20 at Dahej at a cost of 110 crore rupees. Project for specialty fluoropolymers at a cost of around 600 crore rupees. This will be funded by a mix of internal accruals and debt as well. Beat this time around was led by the chemical segment. Specialty chemicals performance was strong because of the new capacity, and also the refrigerant gas that benefited from higher export prices and increased domestic volumes as well. Jeffrey says now in their packaging segment, both BOPP and BOPET prices, they are seeing some pressure because of new capacities coming in globally, and this is something that the management had alluded to as well earlier, and that is something that will put pressure on their packaging segment. The conference call is at 3 p.m. today, so we'll get more details in terms of the management commentary as well.
Okay, all right, Sonal, thanks very much for that. That's on SRF. Just want to point out Mangalore Chemicals and Fertilizer as well, since we are talking about earning reactions. Strong numbers coming in for Mangalore Chemicals and Fertilizers. The stock is up 6.5 odd %. So besides the entire agro theme that is playing out ahead of the budget, we do have it reacting to what has been the highest profit in around 13 odd quarters, and the margins which have been the highest in around 8 to 9 quarters as well. That's what Sonal tells us in her analysis of that particular company. Take a short break, but we'll get you more on the markets, more on the economic survey once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC-TV18. So we're tracking, of course, the economic survey and more details on that. But in the meantime, there are plenty of other things to look at. This afternoon, the auto stocks are doing quite well. Now, remember, there are a couple of things to watch out for. There are auto sales for the month of January that are due tomorrow. So amidst all the chaos of the budget, you'll also have the auto sales data. And it is expected to be a strong showing this time. There's a healthy growth across most segments, whether it's passenger vehicles, medium and heavy commercial vehicles. In fact, it's because of the premiumization that we're seeing in passenger vehicle space, the rise of SUVs, the demand will be skewed towards that segment. The industry volumes overall are expected to grow by 21% in the passenger vehicle space, and in the medium and heavy commercial vehicles, the industry volumes growth could be 26%. The only pocket that continues to be a niggling worry is two-wheelers, A, because rural demand has not improved as much, and B, because exports are under pressure. So volumes in two-wheelers are still down almost 30% from the peak that we saw in January of 2018. Let's get you some estimates on specific companies. These are Nomura's estimates. Maruti, the volume growth is expected to be about 13% at a little over 1.7 lakh units. M&M will be, a star performer this time because of its new launches, as well as going into the budget. The expectations are that there could be more subsidies on the electrification side. So total auto volumes expected to grow 35%. Tata Motors, total volume growth will be about 10%. TVS Motor, the total growth could come in at 10%. And in the MHCV, on the medium and heavy commercial vehicle space, Ashok Leyland is really the stock to watch out for. 26% growth is what we're expecting on the volume front, while two-wheelers, both Hero and Bajaj, could be on the back foot. Hero Motor could see just a single-digit volume growth of around 8% coming in at a little over 4 lakh units, while Bajaj Auto has been struggling with exports. So the expectation is that the volumes could fall about 17% year on year. These are Nomura's expectations, so keep them in mind as well. But moving on, we caught up with Dheeraj Agarwal, who's the co-head equities at Ambit Capital, to understand how he is going into the budget and what are his expectations from the market overall. Listen in.
Expecting fiscal deficit to be lower and to be contained, and the central government push on the capex and infrastructure to continue. Whether that's enough to drive the market higher is another question at this point of time. Our preference is at this point, a huge rally, despite whatever the budget does or tries to do, is going to be a bit difficult. So still looking at a little bit of a range-bound market scenario with a slight upward bias, but not a completely breakaway market. Banking should see some margin pressure going forward because credit growth has been running like mid-teens, 15, 16, 17%, but deposit growth only 8 to 10%. And the surplus liquidity which the banking system had been almost completely utilized. So at this point, there is no option but to chase deposits a little bit, which will result in some impact on the margin. Banking stocks might have fallen for a different reason at this point, but at least after this fall, hopefully this little bit of NIM pressure with that we'll see may not really impact the stock prices too much of the downside. So they are certainly buy the dips, but the kind of returns that we saw in banking space last year, don't expect that to be repeated this year. There are lots of fault lines appearing in the market this year, and if at all we do reach a fair value, it's going to be a rocky path with lots of choppy up and down movements, or it's quite possible that we may actually miss it as well, although that's a theoretical fair value basis EY/BY model, because a number of fault lines are appearing. So my preferred market bias at this point of time is we continue to chop in a broadly 10% range, 10-12% range without going anywhere this year as well. So quite similar to what we saw last year. We chopped up and down 2 or 3 times, ending the year with just 4% gain. I'll be surprised. I'll be surprised if I see more than a 4 or 5% net move in the market on either side come December.
Okay, so that's the view on equities, but let's get some more details on the economic survey. We do have source-based information at this point in time that we are picking up. Back to Shireen. She's tracking it closely. Shireen, over to you.
Well, you have those flashes on your screens, Ekta. FY23, the real GDP growth is expected to be at 7%. This is in consonance with what the NSO has been saying as well. And as far as the next fiscal is concerned, as we've been reporting, a headline GDP growth of 11% in nominal terms and 6.5% in real terms in FY24. And again, as we've been pointing out, this is again in line with what the IMF, World Bank, etc. have been projecting. Now, let's talk about what the survey believes will be the growth accelerants or the growth drivers. The survey articulates that the expansion of the public digital platforms will aid and further boost growth, whether it is in terms of access to credit, finance, etc. That is the expectation that the survey has, that the expansion of the public digital platforms will aid growth further. The survey also talks about the fact that programs like the PM Gati Shakti, which are already underway, this was, of course, a previous budget announcement that the PM Gati Shakti plan will also ensure that infrastructure development moves at a faster clip and hence will aid growth as well. The National Logistics Policy, remember this was last year's budget announcement, that, of course, is also in the process of being in execution mode. So it is work in progress, and that hopefully should drive growth as well. And of course, the PLI schemes, remember the expectation is that in addition to the schemes that have already been announced, the government may announce further PLI schemes for sectors like toys, etc. Employment generating sectors may get their mention in this year's budget, but that, of course, is the big question at this point in time. But these are the growth accelerants that the economic survey is pointing at. Also talking about unemployment data, suggesting that both on the back of data that's coming in from the periodic labour force assessment, urban unemployment has come off year on year from 9.8% to 7.2%. That is for the quarter ending September. So that's what the survey is highlighting in terms of the recovery that the economy has seen post the pandemic, and of course some of the growth accelerants as well.
All right, Shireen, thanks a lot for that. So that's the Economic Survey 2023. Let's do one thing. Let's also take a quick look at what's happening in the market. The Bank Nifty is still holding up with gains of around 250 odd points, but nothing else has changed really. It's absolutely quiet for the sensex and the Nifty. So very flat. The needle has not moved much, which is, I guess, a good thing. Just wait and watch mode ahead of the union budget tomorrow. Let's slip into a short break. We'll get you more on the markets and stock-specific action on the other side.
Well, just let me highlight what the survey is red flagging as far as the current account deficit is concerned, Sonia. And the survey does seem to suggest that there could be multiple risks as far as the current account deficit is concerned, and especially on account of the external environment. It does talk about the fact that because we are likely to see strong domestic demand, growth is expected to continue to be robust. That will raise India's total import bill and contribute to unfavorable developments in the current account balance. And these could perhaps also be accentuated or exacerbated on account of a slowing growth as far as exports are concerned. In fact, the survey talks about the possibility of plateauing of export growth on account of the volatile global demand situation. But it also highlights that because of slower global growth, there could be two silver linings for India specifically. One, oil prices. We have seen oil prices cool off quite sharply off their highs. Oil prices, according to the survey, likely to remain on the lower side on account of slower global growth. And because of that, India's current account deficit will be better than projected. So that's the hope as far as the current account deficit is concerned. But the survey does highlight the multiple risks that we could potentially see on account of the global volatility and the global macros that we will need to be mindful of and be prepared for. But on balance, positive on growth, positive on further accelerants to growth. That's the indication that the survey is throwing up. As we pointed out, 6.5% for FY24. In real terms, that is the number that the survey is highlighting.
Okay, all right, Shireen, thanks very much for that. So we will probably hear more from the Parliament with regards to the tabling of the economic survey soon enough, and more official comments. As of now, these are sources, but this is the large expectation which is expected from the economic survey. But let's talk about a couple of numbers then. Sun Pharma will be reporting its numbers this afternoon. That's what we're told. And remember that the stock has actually been very close to its fresh high ahead of its numbers. So it's at around 1,038, as you can see on your screen. For this quarter, we are expecting a revenue growth of around 13% margins to probably come in at around 26 to 27% and a profit growth of around 4%. Now, a couple of important things to to remember with regards to Sun Pharma is that last quarter when they reported numbers, the numbers were strong and the company, the stock hit a fresh high. So that momentum is expected to continue. This is despite weak numbers from Taro, which is their US arm. Remember, the US arm did report their numbers a couple of weeks ago, and that was a sluggish set of numbers on a year-on-year basis. But Q-on-Q, there was a recovery. Now, this quarter, like every other quarter in the past, maybe fiscal odd, Sun Pharma's growth is expected to be led by the specialty sales business, which is basically a couple of key drugs such as Ilumya, which is a psoriasis drug, Sequoia, which is an eye drug, Winlevi, which is an acne drug. In Q2, for example, the specialty business was up 27.5% year-on-year to $200 million. Separately, for the US business, watch out for price pressure in the base business and whether or not it will be weighed down. But there are some launches such as Pentasa generic, which is basically a colon drug, amphotericin B liposome, which is basically one of the drugs which were used for black fungus during COVID. So these could probably aid the overall US business. India, maybe we could expect high single-digit to double-digit growth, so that would be a positive. Margins estimated to be maintained between 26 to 27%. R&D expenses, if they do inch up to around 7 to 8% of total sales, then that would probably weigh on the margins. Commentary with regards to the Halol USFT issues, additional indications with regards to a couple of their specialty drugs will be a couple of important points to watch out for Sun Pharma. So that's what we can expect on that particular company. But Sonia, you're watching M&M.
So M&M has been gaining ground, over the last couple of hours. In fact, it's up almost 2% right now. Now, M&M has seen very good response to the new XUV 400 electric vehicle that they launched a while back. Since 26 Jan, the XUV EV has already seen 10,000 bookings, and the deliveries will begin from the month of March. Now, Nomura put out a note where they say that interest among consumers to own EVs is quite high despite the challenges with respect to the charging infrastructure constraints. Despite all of that, the bookings have been very strong, and that's a big positive. They expect a demand potential of 3,000 to 5,000 units per month for the XUV 400, and Nomura maintains a buy with a target price of 1,616. Now, the other big thing to watch out for is tomorrow in the budget. Remember, the taxation structure is very supportive for electric vehicles, especially for SUVs. Currently, the GST on buying an EV or renting an EV was brought down from 12% to 5%, and the GST on charging stations, so if you go and charge, the GST was brought down from 18% to 5%, so it was made very favorable. But now the ask is to bring down GST on other EV related services as well, like battery swapping, last mile delivery, etc., even on hybrid vehicles. So if the GST is brought down on that, if there is a rationalization of the tax structure, it will be taken very positively by the likes of M&M, Tata Motors, all the EV makers, including the ancillaries like Minda Industries that are exposed to this space. So that's why I'm keeping my eye out on these stocks. But let's do one thing. Let's slip into a short break. We'll get you more on the buzzing stocks in just a bit.